Hi, Peter Jones, Chartered Surveyor, author and property investor, and in this short series of videos we're thinking about property and taxation. And I just want to emphasise something which I've covered in previous videos, and that's this distinction between corporation tax and capital gains tax and when each will come into play. Because I meet so many investors who get confused by capital gains tax, and I think it's worth making the point again. So if I sound like a broken record, apologies, but I know that I've spoken to people in the past, explained to them the situation, and then next time I've spoken to them it's like it's just gone completely over their heads, because it doesn't really make very much logical sense, and I understand that, because when you're talking about capital gains tax, one would imagine that it covers capital increases in the value of the property, and that's what it's all about, but it isn't really about that. The reason why capital gains tax is important to us is because primarily it's a tax for somebody who holds an investment and who finds at some point in the future that they need to sell the investment. HMRC do not see capital gains tax as being a tax for somebody who buys, for in our case, a property and then decides to hold it for 6 months or a year just to try to get the benefit of a capital gains tax allowance. If HMRC have even the slightest whiff that that's what you're doing, they will look at the intent, and the intent was that you were maybe wanting to flip properties, but in order to use the capital gains tax allowance, you've bought the properties in your own name and then sold them to try and use the capital gains tax allowance. HMRC would be very unimpressed by that. As I say, the purpose of the capital gains tax and the capital gains tax allowance was really for anybody who had held an investment for a long time and then found that they needed to sell it. So if you buy buy-to-lets in your own name and keep them, and if your intention is to keep them, but at some point in the future you need to sell them, then you're probably going to be fine. That will come under capital gains tax, you'll be able to use your allowance. If you want to flip properties, then HMRC will say that that's a trade, and that it's trading income, and therefore you will pay income tax, assuming that you're doing it in your own name, which means that you then won't be able to use capital gains tax and capital gains tax allowance. You'll be into income tax. Now the way around this, all of this, is to do it through a limited company, but let's get to the real nub of what this video is about. There are difficulties with that. As I said in the very first video, there is no perfect solution to all of this. Whichever way you look, there's going to be things which work and things which don't work. One of the big problems with corporation tax and owning your properties within the corporate structure is that you won't get the equivalent of a capital gains tax relief when you sell. Now, this is only a very recent change. It only came in on the 1st of January 2018. Prior to the 1st of January 2018, there was what was called Indexation Relief. And the way that this worked was that, say you bought a property 5 years ago, you'd be able to go onto HMRC's website and you'd be able to look up a table by which you'd be able to inflate the purchase price of your asset. What does that mean? Well, it means that if you sold your asset within your limited company, say for example you bought a property at £50,000 5 years ago and then you sold it, I don't know, a week ago for £100,000. Well, in the old days you'd be able to inflate the £50,000 purchase price by the multiplier in the table on HMRC's website, and basically that multiplier takes account of inflation. So that might have inflated the 50,000 up to, I don't know, 75,000 for example, which means that instead of paying corporation tax on the full 50,000, between the difference between the 50,000 purchase price and the 50,000 sale, you'd pay it only on the difference between the inflated figure and the sale. So you'd, instead of paying tax on 50,000, you'd pay tax on 25,000. So that was a bit like the corporate equivalent of the capital gains tax allowance. But sadly, from the 1st of January 2018, that is no more. But on the plus side, just think about what rates you may be paying if you were paying capital gains tax. Well, first of all, let's just think about the allowance. The capital gains tax allowance for 2017-2018 was £11,300, and in 2018-2019 that's going up to £11,700. So that's quite good. If we could get hold of that, that would have been quite good. But let's just think about what rates we'd actually be paying. That's the amount that we can get tax-free. But what tax do we pay on the bit which isn't tax-free? Well, again, the government have been a little bit mean to property investors, because what they've done is they've brought in a double band of capital gains tax for properties and a different band for other types of investments. So, for example, if you're a higher rate taxpayer, and this is important, it's not just one rate for everybody, different rates for whether you're a lower rate taxpayer or a higher rate taxpayer. If you're a higher rate taxpayer, on your normal investments, which would be stocks and shares, for example, you would pay 20% on the chargeable gain, unless it's a property. If you're a higher rate taxpayer, you're going to pay 28%. That's quite a difference, isn't it? Not 20%, but 28%. If you're a lower rate taxpayer, obviously you pay slightly less. If it's just a general investment, which isn't property, so again, stocks and shares, whatever, then you'd pay 10% on the chargeable gain. If, however, it's a property, then you'll pay 18% on the gain. So again, the government are having a bit of a go through the capital gains tax system at property investors. And this is why, as I said earlier, there's no perfect system. The received wisdom is that the best way forward now is to go into a limited company. It's not ideal, but at the current rates, corporation tax is 20%, and that's it. No indexation relief anymore, sadly, but it's just 20%. It's not 28% if you're a higher rate taxpayer. But then, of course, there's the whole difficulty of getting your money out of the limited company, which we looked at in an earlier video. So I just wanted to clarify that. It's probably left you even more bewildered. That's the trouble with the tax system, isn't it? It is very complicated, and from time to time, various learned people and organisations try and encourage the then Chancellor to try and simplify the tax system. Will it ever happen? I don't know. It should do, but there we are. Not my decision, sadly. Anyway, until next time, here's to successful property investing.